This week was rather tumultuous. We had a move, really a pretty wild move, thanks to the Fed minutes, which I think caught the market for a little bit of a loop. If you took a watch of my past couple of weeks in the videos, I said that the market was factoring in basically no rate hikes, and that I thought as we got a little bit closer to the meetings that would start to fill in a little bit, that I didn't think it would get as vastly get as big of a move as we got, but I thought that would fill in a little bit, and that did happen. So the Fed has been doing, I'll tell you this, they are doing all they can once again to convince everybody that they are thinking about hiking interest rates, basing it on, the data. They all seem to keep saying the data is improving. Now, I don't know what they're looking at. The data that they're looking at, it must be the same data that where Jack got his magical beanstalk beans, because the data that I see is terrible. The jobs numbers were a miss. The prior period was a revision down. The Philly Fed was pretty junky. It was a big miss. So the quality of the jobs, again, a lot of part-timing. There's, the average hourly work, we're still below a 40-hour work week. I think it was like 34 and a half. It's just not great. I've talked about the automation and AI. I will get into that a little bit in a moment, but nothing that I'm seeing says the Fed should be hiking. Now, does that mean that they won't hike? The answer to that is we don't know. The Fed may decide that the markets are at highs here and that they can stomach another hike. I think that would be a catastrophic move, and I think that would result in about 200 S&P points to the downside, probably in a fairly straight line. The markets, as I've discussed in past videos, are exceptionally high for a few reasons. The main big reason is the Fed, that there is PE multiple expansion. We know that the quality of earnings of late have been fairly weak. We know that we're in a bit of a growth recession, I would say. We're not in an absolute recession, but in a growth recession. Top line for sure, and the bottom line has been bolstered by stock buybacks, paying out dividends. Buybacks are amazing to make bottom lines look better than they necessarily are. And it also has a lot to do with executive compensation, but that's a whole other story. The bottom line here is we've had PE multiple expansion. The market is trading roughly around 19 times earnings. In the past, peaks of markets, meaning market tops, the most recent being 2007 and then I believe 2001, the market had been trading with a risk-free rate, a Fed funds rate of about 5 to 6%. Also in 1929, when the market peaked, we had a 6% Fed funds rate. That seems to be the magic number to pop stock market bubbles. Also in 1929, the market peaked at 30 times earnings that summer. I know there's been a lot of, some of the data on the internet talks about the PE multiple peaking lower. The data doesn't go to the absolute peak. It starts at a different period of time. So if there's any confusion on that, that should answer your question. We all know here that the market is trading, excuse me, I just had to plug in, my phone was dying. We know the market is trading at a premium, and I've speculated and hypothesized that the market deserves to trade at a premium as long, and this is the key, as interest rates are low. They are currently below 2%. These are unheard of levels. Companies can do projects, finance projects that they might normally not be able to do given the low cost of borrowing. In addition, and this is the most important part that I think traders seem to miss, and I think it's because for the most part, people who are trading these days, I don't know if they were finance majors, what they did in their prior lives, but they clearly don't understand the stock market. It's common, and I see this like every I would say almost every day. People are, the market's so high, it's unsustainable. Let me explain something. Bond prices are up huge. Interest rate yields are down huge. This is a global phenomenon. You have low interest rates basically for the most part around the developed world. I'm not talking about, banana republic countries that can't pay back, their debt. I'm talking about in Europe, Western Europe, and the United States. Civilized markets, liquid markets. These interest rates are very low. When you do what's known as a discounted cash flow analysis, which is how you measure prices of stocks, there is a risk-free rate component. That rate is exceptionally low now. That requires the market to trade at a premium. How high of a premium is another story. Everyone says that eventually, this is going to have to end in a crash, and yes, all bull markets. I guess the line that I'm thinking of is everything that has a beginning has an end, sort of like in the Matrix. And yes, that very well may be the case. The question is when? And that is going to depend upon, I guess, a number of factors, but largely the Fed, when they decide to kind of stop the music, the pull, the rug pull of the easy money. That is really the conundrum. And if the Fed starts hiking interest rates into a declining economy, that will speed up the contraction of that PE multiple. That's really what's happening. You either have to have an acceleration in growth to offset that, or you have to keep rates lower for longer, like I said. Now, Janet Yellen, in her speech, I just want to look up the exact date. That was the day that I clarified. I think it was March 29th, I want to say. She basically laid out the premise that she was game again for lower for longer. Right before then had been the same Fed chatter that they were going to start hiking interest rates, and we're talking about a better economy. And Yellen kind of pumped the brakes there. She talked about a weak global economy. She talked about what was the phrasing she used? It was so interesting. The gradual pace of gradualism. These are amazing tongue twisters. Sort of almost sounds like she's playing drinking games, right? And coming out with things to say. But she was basically talking about also symmetry. I read that. My interpretation of what Yellen meant by symmetry was she'd be okay with a little more inflation because we've been below the 2% target for so long that maybe she'd be okay with higher than 2% inflation for an equal amount of time, which could be years before interest rate hikes. She also talked about not reaching the 2%. Screen keeps going in and out. I just want to make sure that the broadcast is okay. If someone could just type something, it just keeps flickering on and off. And I wasn't sure if you guys were still live. It reconnected. Okay, so everyone can still... Yeah, I know, the connection's a little weird, right? This is the unfortunate of a live broadcast. Yeah, I know, the sun is... I have the shades down, that's why the sun is bleaching out the screen. I apologize. The only other thing I could do is maybe put on my Yankee cap, which not really going to help. Anyway, let's get back to it. So, where was I? I was talking about the Fed. I was talking about, with Yellen, the gradual pace of gradualism and also the symmetry in markets. These dunderheads, these Fed heads, keep coming out and talking about rate hikes and that maybe that we're getting close enough to their goal. They seem to all have itchy trigger figures. I don't necessarily know if they again, what they're going to do. I would say, based upon everything I've seen, based on the data, they should not be hiking in June. They should not be hiking in July. They should not be hiking until the growth returns and we have a more than 2%. I don't know how they think they're getting to a 2% inflation rate with a GDP rate that can't crack 2%. It's just it's laughable. So the big increase, everyone was talking about, there could be some inflation. The couple of points that had inflation were energy and basically housing. Rents are going up. I will tell you this. I have a lot of experience. This is a bit of a sidetrack. I'm going to try and I really want to fix this color. It's just awful. I can't get it to get better. So this is my experience with real estate. we're about 6% or so past where we should be as far as the ratio of people owning homes to renting. And that is putting a tremendous strain on, as there's more demand, the price has to go up. It's just simple supply and demand metrics. So the prices of rent are up huge. There are people, I guess maybe because they have no savings, and the banks now aren't issuing, those ninja loans and all that tomfoolery that took place in 2005 that caused the financial crisis to unfold in 2007. So interest rates are low, but it's very hard for people to get loans, and people are renting. And the economy has a lot of hidden weakness that I've discussed ad infinitum. Anyway, my point being is that housing has I guess a little bit of inflation, as does energy, and that's really just been the bounce from oil. Oil came down from 110, got down to 26, and now it's back to close to 50. By the way, how'd you like the timing on the calls to my call to sell oil at 49? Wound up being 49s plural. It was into the 49s. So that wound up being the correct. So that's really what the Fed is looking at. Based upon what Janet Yellen has been talking about, they look at three charts. Write this down. The S&P 500, you could use SPY, you can use SPX, you can use whatever you want. HYG, that is the high yield bond fund, where you would see credit problems. And they look at China, FXI. Those are the three charts they look at. When the Fed had their meeting, FXI had been performing a heck of a lot better. It has since come down quite a bit. Check for no higher interest rates. I'm just reading what someone said about the problem. The lighting is a big problem this time of year here. It just comes in and it floods the room. The S&P up near the highs. Check for the rate hike. So now we're one. The other issue is the HYG. And this is, again, not in the favor of not having a rate hike. It's actually a check in the issue for having a hike. When we had Yellen's speech, HYG was in a cascading type of a fashion, and now it has been rallying. As that pressure, whenever you have, and I don't care what any of these technicians and chartists talk about, this is the truth. Whenever you have a major downturn in the markets, like a crash or anything more than a normal correction, it's usually because of credit contraction. HYG is a good proxy for that. For the layman, I don't expect anyone to go in and look at LIBOR spreads and CDS and other exotic things, although believe it or not, I keep an eye on these things, and there is nothing in there right now that's telling me there are major credit issues. But if anything, they're improving by measure of the HYG, so that gives them a little bit of cover. The question is here, does the Fed say, okay, the economy will kind of never get better, this is as good as it gets, so we got to kind of start hiking some interest rates and starting to normalize a little bit? Or do they say, go back to Yellen and say the symmetry and that things are, we're going to leave things for a while until we really start developing inflation? Someone's asking me if I could talk about the relationship between HYG and SPY. All right, so HYG is a risk-on type of a barometer. It's sort of the reach for yield, so to speak, when people are looking to, look, treasuries, CDs, if you go into a bank and you try and get a certificate of deposit, these are low-yielding instruments. There has been a lot of push into risk assets. HYG, for example, yields 5.5%. TLT is yielding only 2.4%. This is sort of the, yes, municipals also. If anyone has noticed MUB, that has been ramping too. That's been a little bit of a chase for yield, although now it's only down to 2%. It's probably not as good of a play. So since people are looking for yield support, they need money to put in for income. They often, when yields are low, and this is what are the seeds sown for financial crises, they put it into riskier assets like a HYG or a JNK, things that aren't They sacrifice on credit because they think times are good and people can, the companies can pay, but they are going into riskier and riskier assets. This is sort of what happened with all that mezzanine financing. I don't want to get into too much of the details of the financial meltdown. It's out there for those that are curious. If there's enough interest here, I'd be happy to explain what happened in 2008 and 9, the crash, but for another time. But if there is enough interest, just leave it in the comments, and we could work up, I could work that into a section of another video. But they are taking riskier and riskier bets, and this is what is the chase. So the Fed gets a little nervous when high yield, the spread of riskier assets over the risk-free rate, starts to get too wide. It starts signaling credit crisis. This came down huge. The peak that I'm looking at, by the way, was 96.30. The peak before the major dump was in June, I want to say, from last year. And from June until February, it went from 95 down to 75. It stopped just short of the 61.8 of the entire range, and it's bounced quite a bit. We are basically had a little over a 38.2% Fibonacci retracement, so we're not even halfway back from the dump. I personally think it's a little premature for the Fed to go into that. Yes, HYG is a little bit more risk takers. When it vacillates in a tight range, okay. When you start having amphalotic selling day after day and it starts getting steep, that starts signaling stress in the financial system. A lot of that pressure has been relieved here, at least short term. I think a lot of that was because of the Fed, also because of the oil rebound. Having oil rebound was very important. We know that a lot of the fear of these weaker, I guess some of this weaker debt was based on oil. Weaker hand companies taking on a lot of debt to finance rigs and projects that had a bigger, higher dollar price of oil for break even. As oil was down in 26, bankruptcies seemed a lot more possible than oil up in the 40s. That is really 44 to 45 is for many projects, and I'm not talking about, the pie in the sky, guys. I'm talking about for most respectable projects, around there is break even. So this probably staves the pressure. Oddly, the example I gave for the stress that these companies were going through were sort of the mouse and the bell experiment, where you take a mouse, you put him under a bell, and in the beginning, the mouse breathes normally, but as he sucks out more oxygen, he starts breathing faster and faster, depleting his supply faster and faster. And what was happening was you had these companies, as oil dropped, were pumping more and more and more, further depressing the price of oil just to make debt payments. So oil being able to rise allows a lot of these companies to hedge at better prices out of the pressure, hence why HYG has been rallying. That's really what's going on here. I don't know what is going on with this connection. It just keeps going on and off. If you happen to be catching this, I just want to take a moment. If you're missing this broadcast, or you can see this again, it's going to be posted on my YouTube. I know it keeps clipping in and out. If you miss any of it, just go to my YouTube channel and you'll be able to see it. If you miss any in and out, this is unbelievable. So that's the story with that. Anyway, that's what's going on with HYG. That's really what was going on with oil. That was going on with the fears. So you really need oil to kind of hang out here. I'm expecting a bit of a pullback in oil. It's been rather that it dumps too hard, then we're back where we were. So the Fed is, they're looking at oil. Oil a lot. S&P has rebounded a lot, and HYG has rebounded a lot. The only problem has been the FXI. That's sort of been down in the tank a bit. And if the Fed, I think the Fed is foolhardily thinking that they have an environment they can raise in, but the data, like I said, the jobs numbers are not good, the GDP is not good. There really is no rush for them to hike here. I really don't understand what they're talking about. So that's the deal with that. As regards to the metals, someone was asking about the metals. So silver and gold and, believe it or not, platinum, which has been majorly outperforming, are all priced in dollars. The dollar has been rising. If the Fed is going to hike, that means higher dollar. The good news, that's also, by the way, I'm going to create a list of the charts that you need to, let's go through it quickly here. If you want to take a note, I'm going to create it on the fly. The S&P is what the Fed is looking at. The HYG is the chart they're looking at. They're looking at FXI. They're looking at the dollar, the DX, and so SPY, HYG, FXI, and the dollar. I think those are really the key ones here to watch. So those four really. With regard to the metals, as the dollar has rallied, the metals have pulled back. I think it was just that they got a little steep and they're pulling back. Silver is holding the 50-day here roughly, a key level to hold. It's also roughly one gap fill. I've been long silver since like the 14s. I'm going to hold it for a while if I can. GLD got a little bit charged. I'll tell you this, a lot of people I know who are sort of metal bugs have been very excited lately based on these charts. And I think it just got a little bit overheated and is chasing and is pulling back. I like gold when it hits 61.8 fibs. That would be 109 in the GLD. That's really far from here. I don't know what would cause that move. Maybe the Fed not hiking. If the dollar, the Fed hiking could cause that. If the dollar spikes, you could get that move down in the metals. If not, it'll probably resume the move upward. So it's again roughly holding the 50 MA, very key level. So if you're long, you could use the 50, a close or two below the 50 MA as a stop. That's my story with the metals. Let's see, SPY. All right, so let's just get down quick and dirty here with SPY. We've been, as you know, in a weird pattern with SPY. The times to have gotten very nervous with SPY, I've talked about, is on days where we have Friday in particular closes below 204.12. That's a proprietary level I have. It's the real upper distribution low, the true demarcation line, and when you close below that on a Friday, it has led to very vicious selling the following week. We were close to a scenario with that yesterday where we had, the day before we had the junky, the Fed notes, and then the move lower, which could have been construed as a look below and fail. The fact that we are over the hammer from yesterday on a closing basis and above the Yellen day high was 205.25. The breakout of that range was 205.23, so I use I'm usually the more stricter about those. I'll use 205.25. Let's just use that because that was the Yellen high of day. Anything above there is more firm ground. Below there gets a little iffy. We have banged on 204 a lot of times. I kept on saying this. The more you bang on a support, the less the support becomes. Yesterday, finally, we had the look below, and it wound up being a failure. The thing that was key, and I'll tell you, it's really rather amusing. This is just a side note, and me not, I don't want to come off as too snotty here, but I guess there's no way to avoid it. It's rather amusing to see everyone who thinks they're a technician these days. It's actually ridiculous. Everyone was I can't even tell you how many over the weekend and the last weekend and the week. I look at some of my, I guess, competition on occasion, some of the stuff they post. In many cases, it's complete gibberish. It's not even actionable. It's just not great work. I don't want to get into anyone's name or to put anyone on blast, but I'll tell you, some of these people have large following bases and they really don't know what they're talking about. A lot of people on Twitter, frankly, don't really know what they're talking about. So I saw all of these drawings of the head and shoulders pattern, and people were, it's like basically saying it's raining outside. What they forgot to mention is it a light rain? Is it a drizzle? Is it a Category 1 hurricane? Is it a Category 5 hurricane? No, it's rain. So yes, we know that the market got into the 210, 211 resistance, which I talked about. I said take profits. We will play a little wait and see to see if the market pulls back hard and fast, steep, or if it's a gradual kind of drift lower. So far, it's really been more of the gradual drift lower, which is, to me, less bearish. Yes, it is possible that the gradual drift lower does get steep at a point. This is sort of like what happened between the period of November and when things got really dicey after December, but keep in mind that was after the rate hike. That was really what caused the problem. If I had to categorize the level and the intensity, the ferocity, the ferociousness of the selling, till now, I would say that it is rather weak. The internals on down days, these big, flashy moves, right, that scare everybody, but that are largely done by algorithmic selling. The breadth is 2-to-1 negative, 3-to-1 negative, not even trend day levels. The worst I've seen it is like broaching the 5-to-1 negative, and then it winds up closing down like 2-to-1 negative. This is not institutional dumping. When I start getting nervous, or I shouldn't say nervous, but I should say more bearish, is when I start seeing days that are trend days. That is how the OTF, the other time frame, the larger money institutions sell. They have large blocks of shares to sell, not a couple of hundred, not a couple of thousand, but I'm talking about millions of shares to sell. And you'll see a steady decline down all day long where every rally is sold with 5-to-1, 8-to-1, worse breadth. That has not been the case. I saw one day in this entire move which had breadth that would be like that. And I've even noticed, believe it or not, on up days, and this is usually not the case in a bear market. In a bear market, breadth and internals are worse on down days and weak on up days. The exact opposite has been happening here. We've had down days with rather mild breadth, and then the stronger days have much more powerful breadth. That means that the buyers are really still, believe it or not, in control. We have the move down has not been, we're just a couple of percent from all-time highs. I mean, the all-time high was 213.78. I mean, the market is at in the 205s here. This isn't the end of the world yet. Yes, very possible we could roll over here. I've pointed out, though, that we would have a bit of a pullback and we would go by levels. I go by my levels, and until I see that definitive snap of 204.12, and listen, maybe it happens Monday, maybe it happens Tuesday, who knows? Until then, I can't put on my bear suit, full-on bear suit. I have to be thinking more positively. I will say this, that when markets get tired and there's indecisions, it's very possible that it just, it does have a larger correction. The other day, believe it or not, I saw up shirts I sold in May. Everyone is looking at sell in May and go away. It worked really great last year. Maybe it works again, works really well this year. I mean, who knows? You won't know until it happens. But all I can do is go by my levels, and I made the analogy today that it's sort of like Top Gun. Jester's advice to Maverick. You never leave your wingman. I never leave my levels. I am very stubborn until I see my levels break to the upside as well as to the downside. Once I do see that, though, I'm very flexible. Everyone always talks about wanting to be right. I want to be right, but I want to be on the right side of the trade. And to only be on the right side of the trade, you have to be correct. There's that subtle difference between right and wrong, and that's first stopping being wrong or first stopping being right before you can cross over. So it's sort of like you're right, you stop being right, you're wrong, you stop being wrong, you're right. That little piece in between, as small as it is, the little hinge, it's probably the most important. And I'll tell you a little secret. When I start getting nervous about my positioning, is like, I'll give you the example, most people play long, is when I am starting to massively outperform the market. I beta weight my portfolio. I tend to traffic in these momentum names, so I use the Qs. When I start seeing multiple days, day upon day of outperformance over my benchmark, and then I start getting a couple of days where I'm underperforming, I know it's time to go. That, I'll tell you, anytime I have ignored that, it has wound up costing me more money than I can tell you. But I know that, so it doesn't. I look for days of massive outperformance, day upon day. Sometimes this can even go on for a week. Usually it's 3 days, though. Once it's after 3 days, I start getting nervous. You could either use the American 3 or the German 3, right? Whichever way you want to do it, depending on where you're ordering your beer. You go to the beer garden, I guess you do the German 3, right? Anyway, my point being is that you want to keep an eye on how you're doing, how you're performing relative to the market, and that is a big tell. If you're having day after day of terrible performance, and the market's doing well, you're also probably not positioned correctly. You've got to be a little bit more worried. Anyway, today with regard to internals, they were fairly strong relative even to yesterday, which was a little bit more weak even on the lower end of the day. We didn't close at the highs. We basically stalled today roughly between the 50 and the 10-day moving averages, which was, I guess, a logical point. I think there was a lot of there was also a news story late in the day, which a shooting at the White House, which I think took the market down a bit. Also yesterday we had some news with that jetliner going down, so things have been mucked up a little bit with some terror fears. But by the end of the day, we closed fairly strong. I think 205s today were a big problem for the market because of the expiration. Monthly expirations tend to be tougher. So I'm just watching what people are saying. So that's really what I'm watching. The 205, like I said, the 205. The fact that we closed over clearly on a Friday, not below the 204.12, is more encouraging. The fact that we still held over or a weekly close over the Yellen high is also a little bit more encouraging. I'll tell you when I'm going to start. This is what I'm thinking. If we can continue higher from here, you'll probably start getting the squeeze on. You had a fairly large reversal candle at 206.80. I had talked about this was on the 516, that day high, which was 207.34. I really believe you need to clear 207s and 208s really to get the major move on. But if I were playing short, I'm currently, I mean, I always have some shorts on. I'm not like net short here. I'm actually a little more net long. But if I were heavily short the S&P, my stop would be over 206.80 here. And if we got back over that level, I think that could see a squeeze. So if you see a move above there, that would also be a trend line break. You can be more bullish. If we give out on Thursday's hammer, that low of day, that was the 202.78. It actually bounced a little ahead of where it should. The 201.90 should have been the level. I'm going to show you guys all of this more in the weekend review video on Sunday. This has gotten a little more technical than I wanted. Yes, we're live. Someone just asked if we're live. We are live. The weekend review video, though, will not be live. That I film and I post it on my YouTube channel. If we were to take out that low, I think we'd very quickly see the 200 MA, and we would probably continue down to the 197s. And the 50% fib is around 196. 195 has been a big level. That really would be where we're heading. I think if we start losing Thursday's low, that to me would kind of start shifting the charts a little bit more. Again, we could easily come back up higher. I did a survey on Twitter last week. I think it was like 55% to 45 were more bullish than bearish. This week it was the exact opposite. Very low conviction tape. The bull, like for example, yesterday you technically had the neckline snap, right, of the head and shoulders. Where were the bears? Why didn't they push it? They should have closed the market on the low of day. Instead, they closed it into the prior day's range. Granted, to the lower end of the range. Let me just see. Was it into the body? Close was 204.20. So above the 204.12. And the low of that body, I have to take a look. I'll talk about that in the weekend review. I don't want to waste anyone's time on that here, but it should have closed weaker, and that's why you had the gap up today. It wasn't no surprise to me. I think a lot of monthly pinning, though, like in some other stocks, sort of helped hold the market, like Apple in the 95s, Disney close to 100. These types of things actually, I think, helped the market. So that is S&P. With regard to some of the momentum names, they've been a little weaker. They've been backing and filling a little bit. Amazon and Facebook have really distinguished themselves as being the best. I think people who are really disillusioned with their jobs, their life, their reality, social media has really become the norm, and Facebook is at the vanguard of that. I mean, you have, Instagram is very popular. I talked about the fact that they have basically been using the bar model. If you get the girls, you get the guys. A lot of modeling agencies. I know these are very subtle things that Wall Street analysts don't really know about. A lot of modeling, because they don't know models. I know models. I know a lot of people. They are required by their agencies to get work, for the most part, even to be represented. They need like 10,000 followers. So you have a ton of these very attractive girls posting tons and tons of sexy photos. I think it's pretty self-explanatory. So that's doing really well for Instagram. It's becoming a great means of social media. It was one of the all-time steals, I believe, for a CEO. Zuckerberg bought it for $1 billion. It was considered expensive, and the last time I saw it valued, it was like $35 billion. That's a pretty good return on investment in my view. I will also tell you this about Facebook, which is, I think, lost on a lot of people. Was the transition from print to online, and now it's not only from online, which is like to Google, so from like the New York Times to Google, it's now from Google to social. And Facebook, remember when they came public, the reason the stock went down was because they were having trouble monetizing their social. Now they have monetized the social, the mobile the best. So they're getting tons and tons of the percentages of the mobile ad dollars. A couple of years ago, maybe a year ago or so, this was, I want to say, yeah, maybe a year or two ago already. I don't remember. Someone had asked me, one of my followers, do I ever think that Facebook will be able to eclipse Google in terms of their profits and their revenue? And my knee-jerk reaction was probably not, but I went in and I looked at the balance sheets and I started looking and I'm like, yeah, this could really happen. Facebook, has a ton of users. They're now growing their top line and their bottom line faster than Google is. So that's why you've seen Google kind of stagnating to down, and you've seen Facebook on the rise. They are taking share. They are growing faster. When you have growth in Momo, that's where the money flows. And Facebook is, in my view, it got a little bit overbought. I love it still on dips. It's got to hold the 116 area. If it gets below there, we could have the gap fill. It might even overshoot a little. When everyone is puking it there, that's where you want to be to sell out of the money puts or just nibble on the stock. I do think it will see 130. I just don't know that it won't see the gap fill first and then go. It could just continue drifting. It's going to depend a lot on the market. Amazon, also, we had a litany. A lot of the weakness the week or so has been because of retail blowing up. Macy's blowing up, Nordstrom's blowing up. That took down the Gap. That took down a ton of these big box retailers. The one that did really well was TJ Maxx and Walmart. Why Walmart? They are where people go when they're broke. That's where poor people shop, and the economy sucks, and that's where they went, to Walmart. Target did really well. Why? Because of the woes of Bloomingdale's and Macy's and all these companies. When they overstock, they overbuy. They have to blow out their inventory. They blow it out to TJX. So TJX got a lot of quality merchandise cheap, and people bought it. That's really the deal. They were able to buy it cheap and still sell it cheap. And that's, if you have a really hot retail season, it's probably not as good for TJX. And when you have a weak retail season, it is great for TJX. So that is where it's going. The other place it's going, and we had the retail sales numbers, while the physical retail sales number was down, online was up huge. That is Amazon, Jeff Bezos. That quarter that they put up could go in the history book of amazing quarters. Jeff Bezos, my hat's off to him. He is in the pantheon of great CEO legends. The stock is up really, really big. The last swing low was 474. The prior swing high before that was 696. As long as you hold above that area, we could be talking 1.618 Fibonacci extension. That would be 833.91. That could really happen. My big concern for Amazon here is the seasonality. This has not been historically the best time for tech or for retail, and I think it's probably smart to book a little bit of profits with this. If you want to use a stop, you really don't want to see this puppy get too below the 684.82. That was the real between 684.82 and 696.44. That area is really important. I would be a little more iffy if it got below there. I do like buying dips. I'm hoping for, of course, it'll go higher. Whenever I hope a stock wants to come down to buy it, it never does. It always just goes higher. But I'm hoping for it to have a 50 MA touch, which would coincide with a trend line where I'd be able to sell a bunch out of the money puts and maybe buy the shares for a good right or right out trade. And those out of the money puts would be same week expiration, maybe the following week at the most. That's my story with Amazon. Google, I've talked about. I don't mess with when it's between ranges. I either like to short it at the channel high or buy it at the channel low. The curious case of Tesla. So the bears got all they wanted. They got the secondary. It was a bigger secondary than normal. There was some real shadiness with that. The Goldman Sachs, one of the lead underwriters, came out that day, upgraded it, and then after the bell, they announced a secondary. This should have absolutely pummeled the stock. It did not. The stock went higher. Initially, it got down to 198. I talked about 190 to 191 being a good buy zone. No. They took the stock up, and I tweeted out, and I explained when something went, and I will tell you this is the same for earnings. When a stock is supposed to do something, when they report bad news particularly, and the share price does not go down, or it goes down less than it should, or if it's even up, you buy that stock and you just ride the wave. That means something is wrong for the bear thesis. Either they got overly short or the news was just there are no more sellers. Those shares tend to go higher. A lot of people I know were bearish at the lows. I talked about selling it at 265 plus. Of course, I was an idiot back then, and those same people now into the reference support at the 50% fib around 204, 205. I talked about that being a key level, and I really would have liked to have seen the 61.8, which we didn't. It reversed sooner. Are wrong. The stock is going higher. If this stock can get back over 265, again, it's probably going to see the all-time high. That is my prediction. I've talked about the end of the summer. This is, by the way, as I talked about it not being seasonally good for Amazon, this is great season time for Tesla. This is always when Tesla runs in the summer. It tends to peak at the end of the summer. So on Tesla, the big fear of the secondary is out of the way. It was bigger than expected, and the stock still went up. So, yeah, Tesla. I would say you can own it against that reference low. I'll talk about that more in the weekend review, not to be too much of a tease. Volatility. This is another very key thing. If you're not paying attention to this, you're just in trouble. All right, so I've talked about the channel, the old channel. We were starting to transition, and I talked about yesterday that we were at the channel, the backside of the channel, which has been grim death for volatility, and it wound up closing on the dead low, and then today was a gap and go lower in volatility. We are still over the 10-day, the 20-day, and the 50-day. It's got a little bit of support coming into it. It is starting to make higher lows and higher highs, so we have to be a little bit cautious. Would not be surprised to see a spike into the lower 20s. If it stops there and comes back in, the market is still okay. If it continues to 25 and above 25, we will revisit that. That would mean some trouble. Again, I will talk about this in the weekend review video. Someone just asked about the banks. The banks, you would think, if the Fed was going to really raise interest rates, should be getting jiggy, right? It should be stronger. I'll tell you this, a lot of people probably don't know about this because they don't always know what to watch. Keep an eye. Everyone is enamored with Goldman Sachs and JP Morgan. keep an eye on Morgan Stanley. 26 plus, 26.16 plus. Bank stocks should go higher. Below there are troubles. Keep that in mind. JP Morgan. You want to talk about JP Morgan? So we all know what a stud, right? Jamie Dimon is. He came in, he called the low, the stock has been behaving well. He raised the dividend, so I guess he's paying himself lovely to wait. He had been neutered by regulations, and it's sort of like the bully that keeps emptying their pockets. The Justice Department and SEC, whoever, keeps coming to them and settling with them, and they keep paying and paying and paying. The worry with them also is their, oil book exposure, their loans. I am just not a huge fan of the banks. What I think is the new banks, and I don't know if anyone has been paying attention to this, if interest rates really are going to rise, if you're an interest rate, if you think the Fed is going to be going into a period of hiking, the better entities to buy are, drum roll please, anyone know? The insurance companies. They will make a bloody fortune. Yes, someone just put insurance. They will make a bloody fortune if interest rates go higher, because they take in their premiums and they usually put them in bonds or lend it out or what have you, and that will make them a fortune. And they aren't nearly as hobbled as the banks are. I am a much bigger fan of those than the banks. That being said, some of these banks are trading at some of them below book, tangible book. That means that to me that someone's worried about something. But I don't think the U.S. banks are could be famous last words, are in the same condition that they were in terms of their exposure that they were, in the financial crisis. The European banks, maybe. I've been talking about dabbling with a little bit of CS and DB. I have really great trade location with those. I'm trying to hold those for years. I may get stopped out. If they take out the reference all-time low, I will be gone ski. So just keep that in mind. That being said, if there's improvement there, these could be the buys of a lifetime. If they lose their reference lows, these stocks are going to see single digits where we can revisit the issue there again. Deutsche Bank and CS. CS reported that terrible quarter. The stock actually went up after that terrible quarter, although it's kind of come back down. I think these stocks are just going to tread water for a while. I'm not a huge fan of the banks and all these, these exotic products. I want to buy something that isn't being heavily regulated, that has really great cash flows. I'll tell you, the reason the market has been worried is really more because of this. I'll post this in the link in the description, is the worry about like I said, the rate hikes. And I think what I meant to discuss this before when the video was chopping out. I just remembered it now. If you take a look at what the expectations were, I think it was like single digits, maybe low double digits for the expectations of a rate hike in June. That's jumped to 26%. July now, after the Brexit vote, is at 53%. That's a big problem. September is at 64%. Remember I was talking about everyone being worried about, really the fear was September? That is also now on the table. November is 67%, and December is like a done deal. It's 80%. I think that December will happen pretty much barring, a Noah's Ark type of a flood. I don't know about this, summer rate hike. I'm starting to get a little nervous that they might do something stupid. I don't know that they're going to. Like I said, they shouldn't. The data is there. It says do not raise rates. Would be a really big problem if they do. The Fed, I go by Yellen. I don't go by these other guys. And until I hear Yellen change her tune, I think she would be really if they hike rates now, I will say that Yellen is incompetent, because the last speech she gave, the one I referenced, she was the most engaged, the most cogent I've heard her. She really laid out the issues. Everything I wanted to hear, she hit on. The other guys and gals who are part of the Fed, this Mester and this George, these people are morons. I mean, you listen to them talk. I don't know what they're talking about. Bullard, I mean, I don't know what these people are talking about. Lockhart, that guy has got to be like the poster boy for incompetence in terms of the Fed. So the ones I really pay attention to are Dudley, he's the New York Fed, and Yellen. Those are and of course Stan Fisher because he's the vice chair. Those three. When those three start getting hawkish, particularly Yellen and Dudley, then I get worried. Fisher to me is a little fishy. Keep it like that. But Yellen to me has been really dovish. This would be a huge 180. I mean, from the last press conference to the next, to go from gradual pace of gradualism to symmetry to a hike, she will have lost all of her credibility with me and I think with the markets, and it would really not. I don't think it would be a very ugly summer very quickly. Let's just leave it at that. If they do, like I said, if they hike, I think 200 points on the SPY, or I mean on SPX, which would be 20 points in the SPY. If they don't hike, I do think we will see a bit of a summer rally, but the problem might be that they could talk tough, and that could keep a lid on things. I think that's really what the Fed is trying to do, just keep a lid on things. They don't want things to get out of control. They like this sort of meandering for a while. It allows the market to kind of digest, and it's maybe correcting without correcting. You know, we've been in 3 years of consolidation. 2013, when I was in college, I was taught that the average expectation for stock market return was roughly, over time, supposed to be about 10% per year. 2013 was 30%. So we've gone sideways for 3 years, back to 10%. So that's really what I think is going on. Anyway, I've got to boogie. I've got to go. I got a date with the ghosts, as Bill Murray would say. Anyway, I'll cover a lot more of this on the weekend review video. I apologize for the video interruptions. I don't know what the hell is going on there. If my phone is busted, don't you always love how Apple seems to your phone starts malfunctioning right before a launch of a new phone? I don't know if it's them or Periscope or whatever, but the rebroadcast of this will be on my YouTube channel, which is Justin Pulitzer Trades. I highly suggest subscribing to that. You'll get notifications when I post weekend review videos, Periscope rebroadcasts, and special edition videos. Please leave me some comments, some notes. It helps me make my videos better. I hope this video, despite the interruptions, still came out well. The weekend review video will have no interruptions, and that will be highly technical, and it won't be something you want to miss. Check it out. Anyway, let's knock a couple back this weekend. Enjoy your weekend, and if your bartender tells you they stop serving at 4, you tell him that the spoos trade till 4:15. See how that goes over. It's never worked for me, but maybe it'll work for you. Anyway, have a good weekend and cheers.